Hello everyone, and thank you very much for joining our webinar. We'll wait a couple of minutes for others to log in before we start, but in the meantime, you can scan the QR code on screen to download our recent fuel disclosure report, which will form the basis for today's discussion. So, thank you. We can start. So once again, thank you for joining and welcome to our fuel disclosure webinar, where we'll explore the strategic thinking behind aviation's decarbonisation efforts. My name is Marina Piligu and I am Engagement Officer here at Carbon Tracker. For those who may not know us, Carbon Tracker is an independent financial think tank within the Tracker Group that delivers world-leading research to align global finance with climate goals and assess the financial and economic rationale of the energy transition and the risks associated with continued fossil fuel investment, empowering investors, policymakers, and companies to make informed decisions. Our work, including the fuel disclosure report and the awaiting takeoff report, is all free to access and download from our website, as well as the usual third-party investor platforms. Today's session will run for around 50 minutes. We'll begin with a short presentation from Said, an analyst in the energy supply team at Carbon Tracker, who will walk us through the key findings from the latest report. Following that, we'll move into a panel discussion before opening the floor for your questions. If you would like to submit a question, please use the Q&A function and please include your name so our team can follow up if needed. Joining also Said today is Juan Manuel, Aviation Program Manager at Climate Catalyst. Juan brings deep expertise in EU policy and institutions, having spent several years in Brussels. At Climate Catalyst, he focuses on engaging industry and financial stakeholders on scaling alternative aviation fuels and other decarbonization levels. So I'll hand over to Said to begin the presentation.
Thank you very much, Marina. Just before we start, just want to make sure that I am sharing my screen. Can you see it?
Yes.
Fantastic. So thank you very much, Marina, and thank you everyone for joining. Before I start my presentation, I thought I'd give a quick plan of where I am, what I'm going to cover today. And the subject of today's presentation is alternative jet fuels, which are more commonly known as sustainable aviation fuels or SAF. So there is a huge question of terminology there, and terminology will in fact be the first thing on our agenda today, covering it not only to signpost what kind of language I will be using as part of the presentation, as well as during the panel, but also to serve as a primer for those of us in the audience who are new to alternative jet fuel space or are just beginning to cover it. From then on, I will provide a brief overview of the policy landscape and the geopolitical background. And given that it's pretty much on the news all the time, it's hitting our headlines, it should be quite brief. So from then on, I will move on to an overview of the near-term supply constraints, what's limiting supply out to 2030. And finally, I will be covering the 7 hurdles to scaling up sustainable fuels. And please note the emphasis on sustainable before moving on to implications and recommendations. And I think it's worth at this point outlining what those implications might be to set out the context for the rest of the presentation. One of our key findings is that our expectations about alternative jet fuels as they are today should probably be right-sized. There will, of course, be a role for alternative jet fuels to play in decarbonizing aviation, but it should be only as part of a range of solutions that will be offered and that we'll cover later. So with that covered, let's move on to terminology. I would like to begin with this brief statement. All SAF is alternative jet fuel. Not all alternative jet fuel is SAF. As we'll see in the next slide and in what I'll cover next, there are many ways to arrive at an alternative jet fuel. There are different feedstocks involved, and there are different conversion technologies involved. Together, these form pathways. For example, HEFA, A to J, etc. Sustainable aviation fuels, or SAF, are just a subset of alternative jet fuels. And for us, it is important to highlight this and to show that there is more rigor and more analysis required on understanding the risks and limitations of all alternative jet fuels. So in our overview of the whole market, I think it's worth beginning with feedstocks. We at Carbon Tracker start from feedstocks, and there are four main types of feedstocks that we see. The first one is obvious. This is fossil fuels, natural gas liquids, crude oil, etc., that are being converted at refineries. If you're wondering what gas is doing there, it is used as part of gas to liquids technology in the Fischer-Tropsch pathway. It's not as common, but it is used there. The second type of feedstock is biogenic feedstock, well, which you know as biofuels. So these are things that are familiar to you. This used cooking oil, animal fat, lignocellulosic biomass, which are basically energy crops, agricultural residues, forestry residues, as well as food and feed crops. Now, the final part, the third part is non-virgin fossil feedstock, which can be found in municipal solid waste in the form of products that are being consumed, not combusted. And once they reach their end of the useful lives, they are recycled into energy as part of waste to energy pathway. And finally, you have water, power, and ambient air, which we call renewable feedstock, because in theory, they are in infinite supply, in a virtually infinite supply, so it can be recycled to produce fossil jet fuel. On the conversion technology side, other than the traditional conventional refineries, we also have HEFA, hydroprocessed esters and fatty acids, A to J, alcohol to jet, FT, Fischer-Tropsch, last but not least, power to liquids, PTL. And again, if you're wondering what the fifth technology there is, it is the technologies used to power hydrogen, electric, and hybrid aircraft. But this is not the subject of today's conversation. And I will link you to the resource that we produced in June last year covering zero emission flight. So it's worth going on to the grand reveal, to the whole process flow diagram. And here, you see it's quite complex, and the complexity is by design. The idea is to show that despite this huge biodiversity of feedstock, despite this huge diversity of technologies used, at the very end, the product produced is practically the same. The chemical composition of alternative jet fuels is virtually identical to that of fossil jet fuel. So it can be used as a drop-in fuel, as a drop blended in with fossil jet fuel, or just used in existing aircraft. If it's used in its pure form, it will require a little bit of tweaking around the engines, but other than that, it can be used in conventional liners like Boeing, Embraer, and Airbus. So with that covered, let's move on to the policy landscape. It has been on the news. The UK and the EU are rolling out different mandates. So on the left-hand side, you see the mandates in the EU. And the way you read it, the blue bar down there is the mandate for the e-fuels, the PTL. And the orange one is the mandate for other alternative jet fuels. The grey is what remains as a sort of a quota for fossil jet fuel. The right-hand side, you have the same for the UK. I imagine this is familiar to most of you, and I will not be going too deep into this one, but if you have any questions, do feel free to ask them in the Q&A section. Now, there have been some conversations about revising and revisiting some of these mandates, which we also may cover later during the panel, and Juan can give more insight into that. But despite these conversations about changing these or not changing these mandates, there has been a recent push towards alternative jet fuel, and the cause is obvious. The conflict has pushed up the prices for crude, which in turn pushed up the prices for jet fuel. So you see that refineries, especially in Asia, are slashing output of jet fuel, which in turn leads to renewed interest in biofuels in general and alternative jet fuels specifically. For now, addressing the conflict using alternative jet fuels is not as viable an option as many may believe, because the short-term supply of jet fuels is quite limited. What you see on this chart is a comparison in the growth of total jet fuel demand with the growth in alternative jet fuel supply. So let me grab a laser point and point out. So these three dashed lines indicate potential total jet fuel demand growth scenarios. This is growth modeled at 4%, this is growth modeled at 3%, and this is growth modeled at 2%. And down below, you see the growth. Second. And down below, you see the growth in capacity. What I want you to focus on is the combination of the gray and orange stacked items, which show total potential future supply at 80% utilization rates. What you see on this chart, the one thing that I would like you to take away is that even in a slow growth scenario, where total jet fuel demand around the world grows at just 2%, the supply from existing, under development, as well as announced facilities will not be able to offset even the growth in jet fuel supply. So for every ton of jet fuel demand that will be possibly offset using alternative jet fuels, there will be another ton that will not. And this highlights the structural limitations of current structural limitations of scaling up alternative jet fuels. Moving beyond 2030, moving longer term, we at Carbon Tracker see 7 potential hurdles to scaling up sustainable aviation fuels. And I do use the word sustainable with intent, because while there is a possibility to scale up AGF at a huge scale, actual sustainable fuels will be limited. It's not just about cost and price premiums. You see up top, it's not just about the regulatory limitations, but it's also about the availability of sustainable feedstock. I will not be going through them one by one. Instead, I will join them together into 3 core themes. The first one will be costs. What you see on the screen is the break-even costs of the 4 major pathways, the average break-even cost for the 4 major pathways, HEFA, ATJ, FT, PTL, from 2020 on to 2045. Now you see here a huge difference between the cost in HEFA and ATJ, and then you have FT and PTL dropping in price, but still staying above the baseline that used to be the fossil jet fuel at $700 per ton. Of course, this situation does not apply right now. The market has been distorted by the conflict, but looking longer term, if prices do return to their normal ranges, this is what the situation may look like. The costs is just part of the problem. What we also see is that the regulations, the mandates around the world, and general plans for alternative jet fuels just don't talk to each other. You have relatively strong mandates in the UK and the EU because they have strong guardrails, especially around the use of food and energy crops. But also you have in other areas, in other jurisdictions, mandates that are in one way or another lacking. So this not only creates loopholes for airlines to exploit, but also compliance costs for airlines as well as freight operators. Excuse me. The next problem is something that is a very big concern for alternative jet fuels, is they cannot put space in the ground. until they have got at least some amount of their fuel off-taken. This is a function of cash flow certainty. And because airlines are largely hesitant to hedge out prices long term, they usually do it out to 2 to 3 years, which you see here as an example. Most of the offtake agreements for alternative jet fuels have been signed for like 1 to 2, 3 years, just 13% in the range of 4 to 6. So for alternative jet fuel producers with huge costs of production, as we saw on the previous slide, this is a problem because banks, frankly, don't want to lend to producers without any cash flow certainty, as well as with other risks, including competition, technology risks, etc. This covers the things on the production on the economic side, but there is also a question on the sustainability side that is not being raised enough. Well, that's in my opinion. And this is about the potential climate, nature, and social impacts of different types of alternative jet fuels. I will start with a commonly used measure of the carbon intensity of jet fuels, of alternative jet fuels, which is the total life cycle assessment, which assesses not only the direct emissions in flight that are being produced by these types of fuel, but also the savings that are being achieved by using alternative feedstock, non-fossil feedstock, as well as indirect land use change. What you see on this slide is a huge variety of the carbon intensity. Yes, heifer using used cooking oil and heifer using animal fat is relatively low carbon, but you see on the right-hand side, you have different pathways that produce fuels that are not only almost as carbon intensive as fossil jet fuel, but in two cases, even more carbon intensive than that, meaning it's more harmful than actually burning fossil jet fuel. The carbon intensity aside, there are other issues as well, and one of them is the opportunity cost. There is not enough sustainable feedstock for the pathways that are actually low carbon, for example, Yucca heifer and tallow heifer. So at some point in the future, that feedstock supply will reach its capacity, in which case we'll need to turn to others. Moving on beyond opportunity costs, there are also other threats to climate, to nature, and to society. And I will not go through them one by one. I'll just outline them here. You see the climates to impact, climates to nature, which range from positive to mostly negative. And finally, the impacts on society, which include food security impact. If you have any questions about these, please ask. We are happy to touch on these at the end during the panel session. Nearing the end of my presentation, I would like to outline the 5 key points from my presentation. The first one is that existing under development and planned projects may not be able to offset additional jet fuel growth demand. It may offset 17 to around 30% of that, but the remaining growth in jet fuel demand will still be met by fossil jet fuel. Given the risks that I've just outlined, not just the carbon intensity, but also the impacts on climate and nature and society, we think that investors should assess alternative jet fuel projects on a case-by-case basis, be more meticulous about it, and they should use criteria that cover production costs, the intensity, and impacts on climate and nature. Now, I said at the beginning that alternative jet fuels may play a role in decarbonizing aviation, and that is true. But given that we need to right-size our expectations about these, I think it's worth earmarking a sector or a segment of flight that will be very hard to replace for alternatives, in which case it is long-haul flight. At the end, alternative jet fuels should be viewed as one of a range of solutions, which also includes zero-emission flight, fuel efficiency measures, and improved traffic control. We spoke specifically about zero-emission flight in our previous report, Awaiting Takeoff, which you see on the QR code on the bottom right. So if you'd like to check that one out, please give it a try. Thank you very much. That concludes my presentation, and I'm happy to turn over to Simon.
Thanks, Saeed. So just as a reminder, before we get kicked off into the Q&A session, if you'd like to ask a question, please use the Q&A function. And also, it would be great if you include your name, because if we don't get round to answering the questions, all of them, we can then get back in touch and we can have the dialogue there. We hope to get through as many as we can. So got quite a number actually already coming through. But I think, Syed, I'd like to start with you, if I may, pulling you back to the graph showing future demand and supply growth. And we hear a lot saying the suppliers say there's no demand, the demand side says there's no supply. And your graph, Jason is asking the graph showing future demand supply growth. The supply seems to be based on announced and in progress projects. But many refiners, according to Jason, are doing R&D into alternative jet fuels behind the scenes and may not have announced anything yet. So this graph is perhaps a pessimistic projection. So, where is the real resistance in alternative jet fuels? Is it the supply or the demand? And what ultimately breaks the deadlock?
Well, yes, thank you, Simon. That is an interesting question. Let me take a second. Well, I think starting from the last bit, where is the great resistance, supply and demand? From what I saw on that chart, there is potentially more supply than is currently being committed to by off-takers. So the build out is ongoing, but again, maybe is the hesitation on the part of airlines and other aircraft operators to lock in long-term prices, expecting the spot prices to go down. So that may be this concern here. But at the same time, we have seen the kind of disruption that major supply shocks cause to jet fuel markets. So maybe they'll be more interested in that going forward. In terms of the first half of your question about refineries doing some R&D in the background, I wouldn't be surprised. A lot of oil and gas companies are mentioning that. Indeed, the figures that we pulled are from I think, major AGF supplier, Sky Energy. So I'm not sure if that includes that figure or not, but it is possible. However, whether that will come about or not is unclear. I've looked into a couple of oil and gas companies recently, and most of the revenues are still coming from crude oil and gas. So the question is like, how big are those plants? Until we have some disclosure on that, I don't think we can comment further.
Great, still quite a number. Thanks, Saeed. Quite a number of questions coming in. Here's one. I think it might be one for you. So it's about green hydrogen. We often hear about your green hydrogen being an answer, but there's always a pushback on concerns about the availability and the scalability of green hydrogen at competitive prices. How should we respond to that pushback or that concern? How should investors respond to that?
Yeah, absolutely. Thank you, Simon. So currently, about 101% of existing hydrogen production at global level is green hydrogen, but is expected to increase very significantly. As you know, we rely on clean energy, on clean energy to produce green hydrogen, and right now most of these clean energy, clean electricity is being at electrifying, at decarbonizing first the existing grids, and secondly at also increasing the rate of electrification of the industry. So this is the lowest hanging fruit in order to provide with carbon savings. So following that, hydrogen will come. There's significant policy support. As you know, there's a number of announcements at EU level, so the Green Hydrogen Bank, the EU Hydrogen Bank, the contracts for differences announced also at national level. So that should significantly bridge the gap with fossil hydrogen, so blue and other sorts of hydrogen. And secondly, once this hydrogen production is in place, we would have a second phase, which is basically manufacture of fuels and chemicals with these hydrogen production. But for that, we, of course, need to have to see these hydrogen production in place, which is something that we are certainly going to see because green energy announcements, as you know, and are just increasing, especially in a part of the world outside Europe, so Asia, and most importantly, India and China. So I think that we can be certain that green hydrogen will be available at the scale that's needed.
Okay, so some good optimism there. Nothing like it. Saeed, question coming in here about costs. Okay, and you know, usually technologies, they kind of fall in cost as they scale. But in the case of, why do heifer costs rise over time rather than fall, as is the case with other technology or usage?
Are you referring to the cost from 2020 to 2045 on IATA? Imagine
Yes.
that is the
Yes.
question.
Yeah.
Yeah, I think the availability of feedstock is the key concern. Those figures were pulled from IATA. We analyze it from IATA, and while we don't have an insight into how IATA modeled, I assume that their assumption is that eventually the world will reach the capacity of sustainable feedstock. So as the sustainable feedstock supply reaches capacity, the costs will be driven up. And a chart that I didn't show during the presentation, but it is in the report, shows that feedstocks account for the lion's share of the total production cost. In most cases, it is around 50%, maybe 30%, but in a couple of cases, it is around 80 to 90%. So in heifer's case, I think it's, let me double check. In heifer's case, it's more than a half. So yes, the pure economics, the limited supply drives the prices up.
Okay. Sticking with the sort of cost lens, Juan, if we can talk now about PTL, e-fuels, and how they compare with biogenic fuels on a long-term cost basis. What's your view there?
Yeah, I think that's a great question, Simon. So there's currently a huge gap in price. Right now, we have a low volumes available for purchase. There's no e-fuels production in Europe to date, and we only have a couple of projects in the United States that are supplying e-fuels, not just in the States but also to Europe in a very low volumes. So the huge gap in price is expected to decrease in line with the cheaper technologies, as especially electrolyzer technologies, the cost of the electrolyzers decrease. So on the long run, we can expect e-fuels to be significantly cheaper. But e-fuels actually have a much higher carbon abatement that biogenic fuel, so the kind of biogenic stuff. So that's why they can displace a much higher amount of emissions. That's why producing a much lower volume and would actually be displacing the same emissions as, for example, a ton of biogenic SAF. So that's why if we come back to Said's graph on the regulations, particularly on our EU, the volumes mandated by these regulations are very small. So with ESAF starting only in 2030 with a very low volume, but these will increase rapidly over time as the cost of these ESAF decreases. And we can expect on the long run, as I said, that the cost gap will decrease. But right now, the price gap is very substantial, and that's why policy support is vital. And we have the UK revenue sensitivity mechanism with the allocation round one currently being in preparation, possibly including a guaranteed allocation for power to liquids, and at the EU level, the ESAF Early Movers Coalition, where several EU member states are making financial commitments to support power to liquids.
So nice segue into the next question that we've got here, which is about policy risk. And if we stick with you, Juan, if I may, you mentioned, what is your view on the policy landscape in the EU and the UK? How exposed is the alternative jet fuel investment case to policy change? In other words, to be frank, is the sector overly policy dependent?
Yeah, I think that policy is the main driver actually for these for alternative fuels production. But I think that we can be certain of some baselines are there. So in the case of the EU, we have the EU regulation from 2023 that started its implementation last year with mandated volumes of biofuels, so biogenic alternative fuels. And as a matter of fact, it's proving to be successful because airlines and also aviation fuel suppliers are reporting on their stability reporting. So you've probably seen that in several of the oil majors are reporting that they expect to be meeting the biofuels supply mandates currently and even by 2030. So I think that generally there has not been much discrepancies at that regard. We are seeing some resistance, particularly from the oil majors on the e-fuels sub-target that will mandate the supply of power to liquid e-fuels to aviation fuel suppliers starting from 2030. So this year, this REFI EU regulation is up for revision by the European Commission. The European Commission is insisting on the fact that these mandate is set in stone, and there is no appetite for changing that, in spite of the major challenges we have currently. So none of the e-fuel projects we have in Europe have reached FID. We don't have any guaranteed self-supply of e-fuels in Europe to date. But as I mentioned before, there has been a very substantial financial commitments from the European Commission, from the European Union budget, also from member states' budgets, which indicates to the point that there's significant skin in the game, and that the investments made to date into this industry will not let go to waste. The UK, on the UK side, I think that we need to see the result of the revenue sensitivity mechanism design. I think that work is in progress, work is advanced, but we also, I think that as we all know, we are in a we are facing currently a very difficult political scenarios. But again, as it wasn't the case for the EU, there's been already a very substantial commitments, very substantial financial commitments, which point to the fact that countries are very much committed to developing their alternative aviation fuels industries.
And okay, I'd just like to turn to a question that we've got from the audience while we're on this whole matter of what pushes things forward. Saeed, how do you view the alternative aviation fuel market regarding the current jet price surge, which obviously makes it less expensive than it would otherwise versus others? Is this a good opportunity for the industry to promote, or the suppliers of alternative jet fuels to promote consumption with their customers?
Ooh, yeah, let's start with the geopolitics. Obviously, the closure of the Strait of Hormuz and the subsequent shut-in of 9.1 million barrels of crude led to significant shortfalls in the supply of jet fuel. And naturally, for airlines, there will be a scramble for alternatives. In terms of whether that makes alternative jet fuels less expensive, the answer is no, but it makes it less comparatively expensive. What we see recently is that it was not only the jet fuel price that went up, the conventional jet fuel price, but also the price of HEFA SPK, the only commercially available alternative jet fuel currently on the market. And while it didn't rise as quickly as jet fuel, which led to a sort of tighter spread between the two, it still got more expensive. Not as fast, again, not as fast as conventional jet fuel. So that definitely made a bit of a case for alternative jet fuels. At the same time, there is a caution around how long the conflict may take place, etc. So in terms of the long-term signals, it is unclear. In terms of the short-term signals, yes, definitely for now, whatever alternative jet fuel supply there is will probably be snapped up, especially by airlines that want to meet their mandates and requirements.
Okay, Saeed, so thanks for that. So switching a little bit tack here onto the sort of disclosure level. Juan, maybe I can blend this question, a couple of questions in together. The first thing is, we haven't mentioned alternative jet fuel certification schemes. Most would be certified, for instance, to be allowed for use in the EU or under Corsair, which should address some or most of the sustainability risk concerns. And wider, on a more wider basis, should investors or push for a pathway level disclosure as an industry standard? And so what do we think? We'll start with Juan first and then Saeed will come back to you. What would good disclosure look like then?
Well, I think that the question of certification schemes is very important. They can provide many benefits, and they are key in order to provide certainty for investors, most importantly in these projects and also in the corporations that are using those fuels, basically as a way to reduce their scope 3 emissions, typically associated to corporate travel. But certification schemes do not eliminate the main issue related to alternative fuels, is the physical limitations basically to scale up. So CORSIA, so does the international framework steered by ICAO, the UN agency for aviation, and it is based on the ILUC notion, so the interland use change. And of course, it's under implementation right now, and it's delivering quite a low baseline because it just aims at reductions from 2019 levels, so not absolute reductions. And also, we are witnessing increasing resistance from many countries to the principle of ILUC. It's very difficult to implement, and finally, it is quite logical that if pressure mounts on increasing volumes of alternative fuels needed to decarbonize the aviation industry, so that would in some way translate into pressure to land use. And there's just a limited. So alternative aviation fuels can, to a certain extent, be scaled up in a sustainable manner, but this is really not infinite. So we absolutely rely on the fuels based on water, air, and clean energy, as we mentioned before. So the reliance on the power to liquid pathway is important, and also certification schemes also play a very important role on that because we acknowledge also the potential risks that could be namely linked to hydrogen production, be opposed on water, for example. So I think that certification schemes will have a very important role in the future as they have today.
Okay, so Syed, you've heard Juan's answer. What have you got to add?
Yeah, Juan has mentioned, very good point about CORSIA, is that it is about avoiding future emissions, the growth in emissions, and also about resistance. I think, let me start with the total life cycle intensity. So EU and UK mandates, I'll take them separately from CORSIA, but generally the reductions required in the carbon intensity of alternative jet fuels, they vary. And yes, they may be like 65% for biofuels and 70% for PTL for EU. In jurisdictions like the UK, the requirement is only a 40% reduction in the carbon intensity. And in the case of CORSIA, the requirement is just 10%. So in terms of rephrasing this, they require fuel that is 90% as carbon intensive as fossil jet fuel to qualify. So in terms of addressing the key risk about the basic risk about the total life cycle intensity, I would be wary. And in terms of addressing other risks, the EU and the UK, as I outlined in the policy section before that, they have pretty strong mandates. So they have strong guardrails, but they're not without their own fault. For example, in the EU, there is some amount of energy crops that are still being allowed to be used as feedstock. And while in the UK, there are no energy crop requirements, like there is a prohibition on the use of energy crops as feedstock, there are still other shortcomings. But if you remember, I mentioned other risks and the risks to climate, such as the long payback periods, the risks to nature, such as the risk to biodiversity, the risk of deforestation, and the risk to society, including food security, with subsequent impact on the global economy. These are not included in the ILUC component of the total life cycle emissions. So these are the additional risks that are not covered by either CORSIA or the EU UK mandates. So these are the additional risks that we want to highlight and that we want to emphasize because these are not being spoken about enough.
Yeah, you mentioned payback periods, Side, and I'd like to stick with you for a question here. Um, you've mentioned carbon payback periods as a potential concern. I, what does that actually mean in practice? You know, what are the risks and in other words, what are is that what you've just mentioned? Is that what being underpriced by investors?
Only in the sense that the impact on the global economy via the impact on climate is underpriced. And I think an illustration here is a good way to go about it. You have a portion of land with a portion of the forest. You cut it down today to produce jet fuel, but the forest does not regrow overnight. It takes 20, 25, 30, 50 years to regrow. So this is the period that's called the carbon payback period, during which the carbon that is being ejected as part of a transatlantic flight in a couple of minutes will take years to grow back and resequester the carbon that is being released. So that mismatch between the time it takes to cut down and burn the carbon that is stored in the forest and for it to regrow is what we call a carbon payback period. And in terms of underpricing, assuming that the carbon that is being released today will be resequestered at some point in the future ignores the risks to the climate and to the global environment at large from from the high global warming. And at Carbon Tracker, we've been looking at that recently as part of our series of DICE reports. And the major thesis is that the current economic models may underestimate the impact on the global on the GDP from the climate change. So yes, going back to the question of underpricing, if society at large, if stakeholders don't pay attention to that, if they believe that they will be able to resequester the carbon in the future, then there is a potential impact there.
Yeah, we've got lots of questions coming in, and I'm very conscious of the time here. I'd like to try and amalgamate one. We've got a question here saying, is the projected price of alternative jet fuels a bit misleading because actually most will be blended into conventional jet fuel? And indeed, there is a maximum blend due to fuel quality and safety rules. So in practice, we will be seeing pricing on the basis of blended fuel, a bit like how the current road transport fuels have a percentage of bio content. On that basis, surely the takeoff hedging is not such an issue, and it actually just comes down to the supply side. Is that a fair comment? Si, you've got your hand up. You go for that one.
Yeah.
One is eager to jump in, so we'll.
I mean, Juan, if you want to take this first, I just have a chart that answers your question. And yeah.
We all like a chart, Side. Go for it.
Yeah, let me reshare the screen for a second, see if that works. Yeah. Wait a sec. I decided not to include this in the original slide deck for lack of time. But yeah, I think this pretty much answers your question. This is not a forecast. Just warning, this is not a forecast. This is just an exercise in assessing. What we did here, we assessed the changes in price in response to different blending mandates. So what you see here in the horizontal, in the rows here is the blend required. And you see here the price premium on top of fossil jet fuel. It's either a break-even cost which does not take into account the market costs, or its actual price in case of heifer, like the low market price and the upper market price. So let's take any one of these quadrants. Say a company is required to blend in 10% of the PTL, whose break-even price is going to come with a markup of 450% on top of fossil jet fuel. The change in price is going to be just 11%, and this assumes that the price of the share of fuel in the price of a ticket stays the same. Obviously, at 70% blend with the PTL break-evens today, it's a huge increase, but obviously no one is flying on 100% ETL, on 100% PTL fuel. So yeah, this is a useful way to look at the prices, and that definitely addresses some part of the concern around costs, both for airlines and operators, as well as for other stakeholders concerned about price. This will be included in the deck that we'll share. So yeah, if you have any further questions, please ask.
Okay, Juan, you've got your hand up. You've got a few moments because I've got two big questions for you to go for.
Wonderful, thanks. So I'd like to reply to a question from a different angle. So right now we don't really have a CapEx issue because currently the ASTM standard allows up to a 50% blend of alternative fuels into existing aircrafts. So it is not required for the airlines to invest in new planes, basically. They may do so. They may renew their fleet, which is also delivering some fuel combustion savings, which of course also help actually to curb the increase in fuel consumption. But right now, it is not a capex issue. Also for biofuels and for biogenic fuels. So currently, the European Commission allows for co-processing, which means that basically in the jet fuel production, a certain percentage of biogenic feedstock will be included in the process, and then the resulting jet fuel can be certified as alternative fuel up to the corresponding percentage, which corresponds to the feedstock of biogenic origin that was used. So right now we just have an issue of being able to translate these higher operating costs of more expensive fuels into ticket price and make it work from a business perspective. I think that CapEx will come at a much later stage, especially linked to the development of power to liquid fuels at a mass scale, and that cost will be assumed, of course, by the alternative aviation fuel producers.
So we're coming to the end. I want to ask a couple of sort of questions, not on a democratic basis because I'm in charge here, so I'm allowed to do that. Now, when you actually look at the alternative jet fuel market and particularly some of the current much vaunted decarbonisation alternative, seems to me they don't really decarbonise very much the whole issue. They tend to put large amounts of stress onto food production, etc. Why are we bothering with these, quite frankly? And on that basis, if you were going to allocate capital, where should the capital go if you're going to actually decarbonise aviation? Who wants to go first? Saeed, Juan?
If you want to go first, go ahead. I do have some thoughts to share on that one. Thank you. I
Good.
think
Yeah, I will go first. So I think that still capital needs to be allocated into these biogenic alternative jet fuels because there are the mandates. So the mandates foreseen that biogenic fuels will not just be transitional, but will also be part of the final picture of how the market should look like by 2050. So concretely, the REFI EU mandates basically an equal share of 35% of biogenic um, biofuels, 35% of e-kerosene, SAF, and a 30% remaining of fossil jet fuel. And I think that it is a matter of risk. So I think that biogenic fuels actually have a substantial risk entailed, and asset owners, asset managers really need to have risk mitigation strategies associated to their financing and also their purchase by corporates by corporations. So I don't think that these are to be avoided. These are a necessary step forward, but these should not be the absolute focus in the overall picture of aviation decarbonization.
Said, last word to you.
Yeah, I think Juan pretty much outlined everything, most of the things that need to be said on the capital allocation side, I guess. Yeah, far be it from me to give any sort of advice or recommendation. This is up to investors to decide. And I think in terms of how to assess alternative jet fuel projects in making an alternative jet fuel project decision, I think like the decision should be based on a range of factors, which I outlined before that, is production costs, as well as carbon intensity, as well as the wider impact. So the idea, I guess, for the whole society, for the entire economy, to decarbonize at scale and to find solutions that will lead to net benefit, all things considered. In terms of the first question that you asked, I was that a question about food security?
Not really. I mean, ultimately, it doesn't sound that, if you want, sustainable. A lot of the, in terms of emissions, cradle to grave emissions, etc., etc. What is there really? Is it? Policy says it should be part of the picture, but really, is policy wrong? And that actually, what we're doing is just robbing Peter to pay Paul.
Well, I'll say this, no one knows the full picture. This is a kind of a difficult question to disentangle. I don't want to give a cavalier answer right now. But does AJF have a role to play in decarbonizing aviation? The answer is yes. What kind of role it has to play? The answer is probably a small one. And in sectors, in parts of the flight that will be very hard to decarbonize, which includes the longer end of mid-range flight as well as long-haul flights, because their alternative technologies cannot be scaled fast enough to be able to fly people over those distances. In terms of short-haul flight, I would say there are opportunities in terms of zero-emission flight, in terms of hybrid aircraft. And as I mentioned before, we did cover this as part of awaiting takeoff, the previous report. So we do unpack it separately there. So there are these solutions. And if you want to talk about low-hanging fruit, these are obviously fuel efficiency measures, and there are things like improving air traffic control, optimizing flight paths, as well as avoiding contrails and other non-CO2 emissions. These things can be addressed. The technologies are at a more mature stage of development, probably more commercially viable, especially if you're talking about contrail avoidance. So these are the things that should be looked at as part of a suite that does include AGF, but doesn't give it the prominent role. I think that would be the way of answering your question.
Beautifully finished off. Look, thanks very much, Sai Kwan, and the team behind the scenes for making this possible. Before we close, you mentioned physical risk, and that is increasingly something that our audiences are interested in. And I'd like to highlight a very significant upcoming report on integrating physical risk into portfolio strategies, valuations, etc. MBIM Ambition Under Pressure is to be released next week. It examines how MBIM manages the physical risk-related financial exposures on behalf of the Norwegian government pension fund. The report essentially provides a practical case study of what good currently looks like when integrating physical risk into portfolio risk and valuation, and asks actually whether policy rather than modelling constraints is now the primary challenge in addressing physical risk. So I think that's a fascinating report. I've read it and it's well worth looking up when it comes out. But for now, thank you all for joining us. We've really appreciated your time. It's not an easy question to answer, the decarbonisation of the aviation sector, and we look forward to continuing the conversation. But for now, bye-bye.
Thank you very much.
Thank you.